Learning Objective 1 is to identify and give examples of each of the three basic manufacturing cost categories. Manufacturing costs are usually grouped into three main categories: direct materials, direct labor, and manufacturing overhead. These costs are incurred to manufacture or make a product. They're also often referred to as our product costs. Direct materials are the raw materials that become an integral part of the finished product and whose cost can be easily and conveniently traced to it. Examples of direct material costs would be the engines on a Boeing 777, the Intel processing chip in your personal computer, the radio in an automobile, the seat and the legs of the chair that you're likely sitting on right now would also be considered direct materials. Direct labor consists of that portion of the labor cost that can be easily traced to a product. Direct labor is sometimes referred to as touch labor, since it consists of the cost of workers who actually touch or manufacture the product. This can be distinguished from supervisor salaries, custodial staff, repair and maintenance workers. These are all product costs and labor costs, but they would not be considered direct labor since the employees are not actually touching or working on the physical product. Indirect labor is part of manufacturing overhead. Manufacturing overhead includes all manufacturing costs other than direct materials and direct labor. Manufacturing overhead cannot be easily traced to specific units of product. Manufacturing overhead includes indirect materials. These are materials that are part of the finished product that cannot be easily traced to it. Again, consider the chair you're likely sitting on. The top of the chair and the legs would be direct materials, while the glue and the machine screws or nails that are holding the chair together would most likely be accounted for as indirect materials. Other examples of manufacturing overhead include maintenance and repairs on production of equipment, heat and light in our factory, property taxes and depreciation on our factory, insurance on the manufacturing facilities. Again, one of the key words is factory. If the cost has something to do with our factory and manufacturing or making our product, then it is considered a product cost. And the product cost, there are three types: direct materials, direct labor, and manufacturing overhead. Our second type of cost is called a period cost. Manufacturing companies incur many costs other than the cost of actually producing an equipment or making a product. For financial reporting purposes, most of these costs are typically classified as selling and administrative costs. These costs are also referred to as selling, general, administrative, or SG&A costs. These costs are incurred in both manufacturing and merchandising firms. Selling costs include all costs necessary to secure customer orders and to get the finished product into the hands of the customer. These costs are also referred to as order getting or order filling cost. Examples of selling costs would include advertising, shipping, sales travel, sales commissions, sales salary, and even the cost of a finished goods warehouse. Administrative costs include all the executive and organizational costs and clerical costs associated with the general management of our company. Examples would include executive compensation, general accounting costs, secretarial, public relation, and the similar costs involved in the overall general administration of the organization as a whole. So again, we've got two types of costs. We've got product cost, which consists of direct material, direct labor, and manufacturing overhead. Any cost we incur to manufacture or make our product. And non-manufacturing costs, also referred to as period costs, and they include selling and administrative costs. Our second learning objective is to distinguish more clearly between product cost and period cost and be able to give examples of each. Product costs include all the costs that are involved in acquiring or manufacturing, that is, making our product. More specifically, again, it includes direct materials, direct labor, and manufacturing overhead. All of these costs get recorded on our balance sheet as either part of raw materials inventory, work in process, inventory, or finished goods inventory. They won't get transferred to the income statement until we actually sell the product. Our costs will be matched with the revenues they help to generate. Period costs include all of our selling and administrative costs. They go directly to the income statement. The idea being, period costs don't provide any future benefits to our company. They will not generate any future revenues, so they'll get recorded directly on the income statement in the period in which they are incurred. Let's talk for a minute about financial reporting under GAAP. GAAP requires the proper matching of revenues and expenses. This is referred to as accrual basis accounting. Under accrual basis accounting, transactions are recorded when they occur, not necessarily when cash is paid or received. Again, GAAP requires companies to follow accrual basis accounting. Accrual basis accounting requires the application of the revenue recognition principle. The revenue recognition principle states that revenues are recognized when in the period in which a product is delivered or services have been performed, regardless of when cash has been received. For example, many products we pay for the product or service at the time the service is performed. Think about McDonald's, think about going to a dry cleaners or a movie theater. Cash exchanges hands at the time the product or performance or the service is performed. Many other times we pay before we receive the product or the service is performed. Think about Millersville. When you pay your tuition, Millersville records that as an asset and does not record the revenue until they actually perform educational services for you. When you buy an airline ticket, the airline will record the cash that you pay them as an asset and won't record a revenue until they actually fly you on a flight. Other situations, you will pay for services after you have received them. For instance, your cell phone bill, your utility bill, these are paid for after the fact, yet the cell phone company or electric utility, PP&L, will record a revenue at the time they perform the service, regardless of whether or not you have actually paid. The second primary rule under accrual basis accounting is our matching principle. The matching principle states that costs incurred to earn revenues should be recorded as expenses in the period that they generate revenues, regardless of when the cash is paid. That is, expenses should be matched with the revenues they help generate. When we think about a manufacturing company, we incur many product costs. And the reason we incur these product costs is we are manufacturing or making a product we plan to sell in some subsequent period. So all of our product costs will get recorded first on the balance sheet, and only when we sell the actual physical goods will the cost be transferred to the income statement as part of cost of goods sold. So again, product costs first get recorded on our balance sheet as part of raw materials, work in process, or finished goods inventory. Once we've completed the product and we sell it to a customer, those costs will then be matched with our sales revenue as cost of goods sold. Period costs, again, include all selling and administrative costs. Since they don't generate any future revenues, they get recorded directly on the income statement in the period in which they are incurred. A final classification or category of manufacturing costs that you often will read about are what we call prime costs and conversion costs. Prime cost is simply the sum of direct material and direct labor costs, while conversion cost is simply the sum of direct labor and manufacturing overhead. The term conversion cost is used to describe the cost of direct labor and manufacturing overhead because we incur those costs to convert raw materials into a finished product. Let's review some costs and see if you can classify them correctly as product costs or period costs. Property taxes on a factory would be classified as a manufacturing or product cost. The key word there is factory. And since it's not direct materials or direct labor, it would be classified as manufacturing overhead. Boxes used for packaging detergent produced by the company would be an example of direct material costs. Salesperson's commissions would be a period cost and classified as a selling expense. Supervisor salaries in the factory, again the key word is factory, would be part of manufacturing overhead. Again, direct labor is the cost of employees who are actually making or assembling or touching the product. So supervisor salaries would be a manufacturing or product cost, but classified as manufacturing overhead. Depreciation on executive autos. The key word there is executive autos. It has nothing to do with the manufacture of our product, so it would be classified as a period expense. The wages of workers assembling the computers would be direct labor, since these employees are actually physically touching and making our product. Insurance on our finished goods warehouse would be a manufacturing overhead cost. Lubricants for machines in our factory would be manufacturing overhead costs. Advertising cost would be a period cost, a cost of generating sales. The microchips used in producing our calculators would be a direct material costs. Shipping costs on merchandise that we sell would be a selling costs and part of a period costs also. Magazine subscriptions for the factory lunchroom. Students often hesitate on this one, but it too would be a product cost. Think, if we weren't manufacturing a product, we would not have a factory. If we didn't have a factory, we wouldn't have a factory lunchroom, and we certainly wouldn't have magazine subscriptions for the factory. So this is a manufacturing or product cost. Thread in a garment factory. It might be accounted for as a direct material if it's significant in amount and easily traced to the product. But if we're thinking about sewing together fabric that makes up t-shirts or that makes up Levi's or jackets, it would be most likely classified as an indirect material and part of manufacturing overhead. Billing cost would be an administrative cost and part of selling and administrative cost on our income statement. It is a period expense. Executive life insurance is another period cost and would be classified as an admin expense. The ink used in textbook production would likely be a manufacturing overhead. Now, if we had very large print runs, say we're printing editions of the Harry Potter book, where we're printing hundreds of thousands of copies, in that case, we might account for the ink as a direct material cost. But if they're small book runs, it's probably not worth the cost of keeping track of the ink on a product or book-by-book basis. So we'll just assign it to manufacturing overhead. Fringe benefits for assembly line workers. Again, the key is assembly line workers, workers that are actually making the product, would be a product cost and classified as direct labor. Yarn used in sweater production would be direct materials, while the wages of a receptionist in our executive office would be a period cost and classified as an administrative expense.